Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and I'm joined by Joe Camp of Comstock Investments. We're going to take a look at the markets on Wednesday. And man, it was another washout on the grain markets. Well, even though the material in this podcast may not be all that bearable, I would appreciate it if you go ahead and like this video and go ahead and subscribe to it and share it as well, because it will have important information that you may need to know and really contemplate as we move forward into this marketing year. Joe, thanks again for being a part of the program here. Well, that was a tough day here on Wednesday. A lot of downward pressure on the market. What is it that the traders are weighing on right now? Are they looking ahead to option expiration or export sales, or what is it that's putting so much pressure on here?
I'm going to sound like a broken record because we talked about this same thing last week. Farmers have been hearing me say it for 3 weeks now, and it's that I can tell you all the reasons why we could see higher prices when we get out of this month, but also that I can't tell you why we won't continue to go lower before February ends. And so that leaves us now with, I think, 6 trading sessions left to go. We got one extra one here this February for leap year. But that's an important date when we look ahead towards the 29th. A lot of what we're seeing go on into the end of this month of February is related to the mechanics of the expiration of these March grain contracts. And so as you bring up, March options expire on Friday. We're looking at where there's relatively heavily struck open interest, like for $4 even on March corn, now down to around 1160, where we're closing today on March soybeans. Those are levels that the board could suck down toward as we close out this week. And then, as mentioned, Thursday next week, first notice day on the 29th, where it's continuing to force farmers to make decisions, farmers for one, but also bullish speculators in this market, retail longs. You know, I think about what the Comstock report was titled today. I think that's Dan's title, Cash Selling to Meet Cash Flow Needs, Still a Drag on Recovery Hopes. And so that goes into play, right? That you're coming up into a time of the year. We've talked about coming up on property taxes or machinery bills or operating loans and all of those things advancing towards forced decision making and forced sales. That's also true with what we've talked about several times over. That's tied to this expiration of the March contract, and that's all of these basis contracts coming due. So it might not just be cash flow needs, it might be cash needed for margin calls and the decision just to liquidate rather than roll forward, the basis contracts that are being closed out here, and ultimately a lot of pressure that could subside once we get out of this month of February. Again, still 6 more sessions to go.
Comstock founder David Cruz had sent out a note earlier calling attention to a post that he made back in early December. And he was trying to make people aware of what he calls a John Deere low every spring when you get around the first part of March. And it seems like, that might be just what is happening right now. There is a seasonal tendency to really kind of crater right now. Do you think that's a big part of this?
I think it is that we're seeing that as one force of many that helps snowball this lower. It's part the technicals. We have a bearish looking chart, and that supports these hedge funds that are holding a record net short position in corn and soybeans. That's one graphic that I thought was really key to prepare for today's discussion, that we have the managed money crowd now with a record net short on corn and soybeans combined. And a lot of their money is traded on the basis of what the chart's saying. So you've got that going for the speculators at a time when these cash longs, the farmers out there, are being forced to make these decisions to sell this crop, to generate the cash flow needs, and to get out of the way here, quite simply. So there is a dose of capitulation that we've seen here in the market these past several weeks. It could, again, be something that clears the way for higher prices going forward. But the seasonality of it, as you mentioned, is not one that's yet awfully bullish. Again, we get out of this month into, more particularly April, May, June. That's going to be a friendlier look historically past that, so-called possible John Deere low.
Well, I hear a lot of talk about if the funds would happen to want to take profits, let's say, that it could be kind of an avalanche. And once a few would begin to do that, it would maybe start a rush. But there has
I
to
think
be something to start that whole process, right? And I just can't imagine what that would be right now.
exactly. The path of least resistance has been lower technically. We saw a day like we had yesterday where there's a small bounce, but an easing of the selling pressure and light short covering is one thing, whereas an actual turnaround and a motivated buying campaign is another. But we go back to a record net short position on these contracts. That is a lot of contracts combined for corn and soybeans. I think over 450,000, more than 2 billion bushels short in the equivalent of these corn and soybean futures contracts. Well, none of those traders want to be the last one out to take profit. And so there can be a rush for the exit, but there has to be, as you say, a motivation or a trigger or a spark of some sort for that. Now, I tend to think it's going to be on the export front. Those are the storylines or the sources of demand that can trigger some speculative bullishness if we start to do better on trade demand going forward. And it's something that does have a historical precedence when we look at getting into the spring months. It relates to what's going on in South America and where they're at in their crop year. Ultimately, I think if we have improvement for exports, we can potentially trigger some more significant short covering.
Is there any kind of a bright spot anywhere in the grain markets right now? I mean, wheat doesn't seem to offer anything either right now.
Yeah, only that sort of seasonal tendency of getting into March and back to the export demand influence. It's been in the most recent years where China has stepped up their purchases of U.S. corn considerably. And I think that can be, again, the case this year as it's tied to these ongoing concerns about the crop losses in Brazil. Not that they don't have improved weather as of late, but they are looking at lower seedings to come off of that at least slightly diminished soybean crop. So as we have further reckoning of those estimates going lower, the USDA still needing to move quite a bit down if they're going to come even close to where Brazil's CONAB crop agency is, starting with this March report. That's going to be something that spooks potential buyers like China into stepping into the U.S. market as a hedge against those potentially tighter supplies available in South America.
You know, for a while, I heard a lot of talk about the fact that maybe a saving grace for the corn market might be the use of ethanol for the sustainable airline fuel or aircraft fuel, aviation fuel. And that may bring in a whole bunch of new demand for corn through the ethanol connection there. Maybe even use more than what they use for the automobile industry. But it seemed like the Biden administration threw some cold water on that this past week.
Right. We talk about negativity here over these past couple of weeks from USDA data. Now leave it to the White House to get in the way of what is ultimately still a friendly storyline long term. I think there is reason still to have optimism. It's simply still incentivized to be able to involve ethanol and soy-based biodiesel in a bigger way, and including that sustainable aviation fuel. But you mentioned a decision where it was at least reported that the Biden administration is going to flip on now using a more climate-friendly type of measure that would underrate ethanol in terms of its emissions involving in that, and then therefore discounting the potential for tax credits. And that's overall a negative here and something we'd like to campaign for change on. We did have an offset in a way, partially, that we could approve, E15 fuel throughout the summer months, which we've already been promised and expected. But that negative ethanol storyline also something that weighs on the market yet this week.
Well, the shining star right now is definitely the cotton market, and kudos to everybody with cotton out there, but it's led by the nearby contracts. The new crop is lagging behind a little bit, but still, if you push the pencil to it, doesn't that come out pretty favorable if you're comparing it to corn in the Deep South?
It does. It's one thing that was reflected in those Ag Outlook Forum numbers as early as they are and as likely as they are going to be off. It was mentioned by the government analysts that there will be likely lower wheat acres here heading into the spring that will shift over to sorghum and cotton. Cotton, because of the now better profitability potential, at least expected by farmers looking at the nearby prices that you allude to. Those farmers in Brazil have also taken note of cotton prices here as of late, and it's something that some of that second crop corn acreage is actually going to have been shifted to here, which could help those estimates maybe move a little bit lower on the corn front heading forward.
So, how are you positioned now on livestock? Are you still optimistic on them, or do you think that they've kind of run out of gas for a while?
Bit of both, and that's looking at it from a short-term perspective, thinking that a correction could be in store. Some of the technical indicators do suggest that, with slight bearish divergence happening with new price highs, but not new highs for the relative strength index or the various momentum indicators. You also have some idea that with pinched packer margins, at least relatively as of late, you're going to have those buyers try to slow things down and maybe stall out the cash market a bit. We'll know more about that likely this afternoon and into the weekend. But long term, still a lot to be bullish about, just with fed cattle supplies as tight as they are and as slow as we know it will be to rebuild numbers from here. We're not very far removed from that last inventory report, reminding us that the all cattle on calves count was at its lowest level since 1951. So at this point, we've made a huge recovery, some $23, $24 off of the December lows for nearby live cattle futures, but still about 10 or 11 bucks off of those highs from last September. So cautiously optimistic here, I'd say.
So, if you're a livestock producer, would you still be going hand to mouth on feed acquisition right now?
Yeah, for the most part, I would, until we could see some semblance of a turnaround for the corn market. You're going to continue to benefit from a slide lower here. It gets to a point where you can start to hedge expected profitability, and not just for corn purchases, but for these cattle futures that have, again, now recovered to such a level that you can look at futures or options to protect your risk heading into those summer months.
Well, Joe, again, thank you for joining us here on the podcast today. I appreciate that. And hopefully everyone will reach out to you with more additional questions or for more information at your contact info. And look forward to talking with you again next time as well. That's Joe Camp of Comstock Investments with us. And that'll do it for today's episode. For producer Brianne Hendrickson, I'm Marlin Bohling. Hope you make it a great day. We'll see you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget, you can also find us on Facebook and TikTok as well.